jobs numbers show an economy that is slowing, a labor market that is slowing, but that is still strong. So, we added 261,000 jobs in October. That's a really strong number, but it's down from more than twice that in the first quarter of the year. Wage growth, if you look over the last 3 months, it's 3.9%. That is much slower than we saw earlier in the year. It was around roughly 6%. So we are still seeing strength, but softening.
Demand remains solid. The labor market remains tight. And, you can point to the unemployment rate. You can point to wages. We're not getting much help on the supply side. Participation ticked down. And I just think firms are still holding on to workers. If you've worked hard for the last year or 2 years to try to get your staffing back up to complement, it's quite a change in approach to say you're going to have fewer. And so I do think the market remains tight, and that means there's still more work to do.
A pretty fantastic October, and a lot of people thought it was going to be a scary month. It wasn't, but that doesn't mean we're out of the woods just yet.
Let's be honest, 2022 has been a tough year for all the investors. Everyone felt the risky side of the equation. Now, job reports have a big influence on the market and all. And we just recently got the latest job report. All things are looking on the brighter side. But is it really? The takeaway from the latest jobs report is that most businesses are hiring at a fast clip. And that's a good thing for the economy, right? But how does the job report affect the Fed's thinking, and most importantly, the crypto market? I mean, the Fed is focused on lagging indicators, employment and inflation. In this video, I'm going to cover what this job report really depicts from Cathie Wood's viewpoint, so stay tuned till the end, as we will be looking at a couple of things, including recent job reports and Bitcoin prices. And if you haven't subscribed to my channel yet, go hit that subscribe button. You can always hit that bell icon to never miss out on any of our latest news and updates. So let's get into the video and see how Cathie Wood finds the tone of the latest job reports.
The Fed is focused on lagging indicators, employment and inflation. So let's deal with those directly. Today was Employment Friday, and we knew that the number was going to be positive. It was more positive. Non-farm payroll was more positive than expected. Initial unemployment claims had been pointing in that direction as well. So non-farm payroll employment was up 261,000, better than the expectation of 190-ish thousand. Average hourly earnings were up 0.4%, a little stronger than the 0.3%. Now, of course, the Fed is railing against this. The Fed wants the unemployment rate, it seems, to be at 4.5%. Well, we started to move up in terms of the unemployment rate. We went from 3.5 to 3.7, partly because the participation rate dropped a bit. So the Fed is getting its wish, I suppose. But you know what's interesting about this hypothesis? It's a Phillips curve, not hypothesis. I think it's been disproven. Phillips curve says, well, if you want to get inflation down, then you have to get activity down. The history of the 80s and 90s and even into the 2000s, if you look at it, is when real growth was strong, inflation was low. Why? Because of productivity. And I think that will continue to be the case.
According to Cathie Wood, better than expected is the term used to describe the latest job report by the U.S. On Friday, the U.S. Department of Labor reported that the U.S. economy added 261,000 jobs in October, smashing estimates of 200,000, justifying the need for further Fed tightening, even though the federal funds rate is already at the 3.75 to 4% range. Digging a little deep into the report, the unemployment rate rose by 3.7%, shocked by a lower participation rate, while average hourly earnings grew 4.7% year over year. Employment report triggered a wave of volatility that ended up being positive for risky assets, which has helped Bitcoin rally above the $21,000 level. A similar action was also witnessed for the Ethereum price. Matic also soared past $1. Let's see what else Cathie Wood has to say regarding this job report and the Fed. But before jumping ahead, be sure to give a big thumbs up to this video. Let's get to the next clip now.
That's what the Fed thinks, and so it's unfortunate, but we're probably going to see unemployment rising. And we're already getting some indicators. So here's the other side that the Fed isn't talking about that much. First, the Challenger Job Survey, it's a layoff survey, And it is showing a 48% increase in broad-based layoffs, meaning layoffs that companies are announcing that cut across divisions and involve quite a number of people. And we also saw that in the Purchasing Managers Index, again, leading indicator, that employment in that index went negative in this last month, October. Then, very importantly, in the employment report itself is buried a number called household employment. I don't know why they don't feature it more, the Fed in particular, because it's much broader based than a non-farm payroll survey, and it includes many more small and medium-sized businesses. It also includes people who are working 2 jobs or 3 jobs, and they'll just say that they're working. And it also includes what's called the birth and death rate of small businesses. And so that indicator, household employment, dropped 328,000. And if you look at it since March, it's been fluctuating, but since March, it's gone nowhere. Now, that's not the picture that non-farm payroll is painting here. But I trust this employment indicator much more than non-farm payroll because it's better at turning points in the market. So think about that. For more than half of a year, this measure of employment has gone nowhere. What we think has happened in terms of non-farm payroll, which is much more big company oriented, is that a lot of companies had so much trouble finding employees over the last 2 years that they're reluctant to let them go because economic indicators are suggesting they should let them go. And if companies become mismanaged enough, then we probably will have more Twitter-like examples where a new and visionary leader goes in and cleans house.
The Fed is rallying against this employment down, so the Fed is getting their wish. Currently, the nation's jobless rate is 3.7%, near the lowest level in more than half a century. But according to Cathie Wood, there's another side of the story as well. She mentioned big-scale layoffs can be seen in the headlines. Mass layoffs are currently underway at Twitter. The layoffs come as Musk was speculated to cut as much as 50% of Twitter's workforce, just days after becoming the head of the company he purchased for $44 billion. Twitter is reportedly not the only latest tech firm set to announce layoffs. Meta also has the same plans. The planned layoffs would be the first broad headcount reductions to occur in the company's 18-year history. In statement after statement, we can all see many big companies are warning that they're preparing for dire times. So what are your thoughts on the recent job report? Are we going to see more mass layoffs ahead? How will it affect the economy and the crypto market? Can Bitcoin rise above and reach 25K by the end of this month? Let me know your thoughts in the comments below. Also, don't forget to like, share, and subscribe. I'll see you in my next video. Thanks for watching, and adios.